Is silver on the brink of a major move? It's a well-known strategy in cycling to win races. Cyclists ride in a peloton formation to conserve energy by drafting behind lead riders. The cyclists take turns being in the front and spending most of the energy. But for the riders behind the leaders, the resulting decrease in air resistance or drag is incredible. In a race where winners and losers are separated by seconds, this strategy can reduce drag by 5 to 15%. Stretch that reduction over hundreds of miles, and the amount of energy saved adds up in a big way. This allows riders to sprint to the front with much more energy. Right now, it feels very much like gold is leading the precious metals pack at the front of the peloton. Could silver be conserving its energy, looking to make a sprint to the front of the pack? Let's start with Silver 101. Silver, or argentum in Latin, has been prized metal since antiquity. Though too brittle to forge swords or armor, its luster and rarity made it a prized medium of exchange. Powerful empires from ancient Rome to imperial Spain couldn't mine enough of it. Silver coins became the unit of account in many important currencies: the Greek drachma, the Roman denarius, the Islamic dirham, and the Spanish dollar. Here's a cool side fact for all the silver bugs out there. It was the Spanish dollar, with its standardized dimensions, that inspired Treasury Secretary Alexander Hamilton to adopt the United States dollar as the currency of the newly founded United States of America. Nowadays, silver has one thing that gold does not: affordability and abundance. Over 60% of silver is used in industrial applications, with the residual sub 40% used in jewelry and silver bullion. There's certainly an argument to be made that silver is a base metal that likes to pretend that it's still a precious one. One of the most important things to understand about any commodity are its supply and demand fundamentals. Silver production has been impacted severely by COVID-19. As much as 66% of primary silver mines production was put on hold from anywhere from 2 weeks to 4 months. Over 101 mines are still affected as of June 18, 2020. This represents about 33.52 million ounces of total production at risk and accounts for 26% of 2020 estimated mine production. A second round of lockdowns would be good for the price of silver, at least on the supply side, but bad news for miners who have to shut in or curb production. So, what are the largest silver producing countries? Over 60% of primary silver production comes from Latin America, or what I call Silver Camp: Chile, Argentina, Mexico, and Peru. And let's not forget, Guatemala will become a major producer once my buddy Ross Beatty starts up the Escobal silver mine, which truly is one of the world's most attractive primary silver mines. Many of those countries are facing a resurgent coronavirus. All these countries have eventually come around to classifying mining as an essential service, but a serious outbreak on a mine site could result in closures. What you're looking at right now is a chart of the estimated global silver production for 2020. However, please note that these production estimates were pre-COVID. In fact, many of the largest silver miners, including Fresnillo, Bonaventura, and Pan American Silver, have withdrawn their production guidance for 2020. Normally, production deficits are a positive for prices. However, the fact that over 65% of silver's demand is used for industrial and commercial purposes is likely crippling its safe haven demand. This is one of the reasons why silver hasn't been performing as well as gold or US Treasuries to date. But there's another reason why most portfolio managers won't put silver in the same breath as US Treasuries, Japanese government bonds, US dollars, and gold. That's because it's simply too volatile to act as a hedge. For this, we can instead look at the magnitude of daily price changes, both positive and negative, for both assets. This chart that you're looking at right now, you can see the volatility of how silver prices have much higher daily percentage gains and losses than gold over the last 10 years. Conclusion: it's a much more volatile asset class. Now, do central banks hoard silver? In short, no. Sorry, silver bugs. Central banks don't deem it stable or valuable enough to hold as foreign reserves. Also, The value of reserves per square foot in the vault is massively inefficient compared to gold. For gold, up to 40% of annual gold demand is for investments, including central bank foreign exchange reserves. Gold prices are primarily determined by its demand as an investment, think store of value. On the other hand, silver prices are as much determined by industrial and commercial users than investors. It's also worth noting that the investment market for silver is substantially smaller than gold. In 2019, about 4.3 billion worth of silver produced went into investments in physical products or ETFs. This figure was over 62.7 billion for gold produced in 2019. Which precious metal peaks first? Well, let's look back at the historical data. It's clear that silver peaks first before gold. And it's true, to its volatile nature, it does so far more dramatically. Silver's outstanding performance relative to gold can be seen from January 1974 to May 1987, and most recently from November 2010 to April 2013. But today, the spread between gold and silver prices is widening to levels not seen in 50 years of pricing data. If ever there were a time in history to play catch up, then now's the time for silver. The chart below shows the first silver bull market from January 1974 to May 1987. The returns on silver spiked to over double that of gold, with silver hitting $48 an ounce versus $850 an ounce for gold. From November 2010 to April 2013, the second bull market for silver was not as impressive as the first. Silver didn't reach quadruple digit percentage gains, yet it still pulled ahead of gold significantly. Currently, silver is 61% off its record intraday high of $49.50 set on April 28, 2011. Gold, on the other hand, is only 6% off its record intraday high of $1,923.70 on September 6, 2011. This means that silver has a lot more room to move up to its record highs than gold if we look from a historical perspective. Now, let's look at silver's technicals. The biggest key to look out for is that psychological $20 resistance level. If the price of silver breaks out above that $20 price, then every trader in algo will start to take notice. That is what the chart you're looking at right now, that band between the red and the green. Below is a long-term chart which shows how compressed silver has been. A consolidation in a $20 per ounce range could provide a base for a major slingshot move upwards. Now let's look at the silver caught, the commitment of traders. In the next chart that you're looking at, you'll see that the non-commercial long positions increased by over 35,000 contracts in the past 6 weeks. Non-commercial positions is a term used by the CFTC to classify speculative futures and option trades. We call this spec traders holding long positions in silver futures are betting that the price of silver will increase in the future. The chart that you're looking at indicates increasingly positive trader sentiment. It would not surprise me to see silver rally like it did in 2011. ETFs such as iShares Silver Trust attempt to track the price of silver at a ratio of 1 unit per ounce of silver. Commodity-based ETFs are not as simple as you might think. These funds are traded on an exchange separately from spot and future markets. For an ETF to track the price of silver, the fund and its market makers must issue or redeem blocks of shares in exchange for bullion. But by necessity, the funds are open-ended. When an ETF adds silver bullion, it is typically doing so in anticipation of having to issue an additional blocks of shares to keep up with the market demand. This is so that its unit, its share price, doesn't exceed the price of silver. The fact that silver ETFs have posted net inflows for 6 straight months is a very bullish sign. So how to invest in silver? One could invest in a silver bullion or silver ETFs, and if it takes off, perhaps you could double your money. But I actually think the best way to get exposure to a silver slingshot move is through the miners. When the price of silver rises, the NAV, the net asset value of many producers, can soar dramatically. Share prices are determined off a company's NAV. So as the NAV appreciates, the share price is likely to rise as well. As central banks and governments around the world continuously pour money into their economies, store of values such as gold and silver can deliver major portfolio gains. Our portfolio has been on fire this year, but still I am working tirelessly on new ideas. I just got back from an international site visit working on a project for my subscribers. As of this publication date, I am halfway through my government mandated quarantine. With little else to do than work, we are putting together a very strong August KRO edition for our subscribers. If you want to know the next stock, companies, and deals I'm working on that fit the bill, and where I'm putting my own money on the line, it's all in my premium research. Be safe out there.